Hey guys, how's it going? Lewis Harding Invest here and welcome back to my channel. In today's video, I'm going to be talking about the price to earnings ratio. Let's get straight into it. The price to earnings ratio, otherwise known as the PE ratio, is the ratio for valuing a company that measures its current market cap relative to its net income. The PE ratio is sometimes known as the price multiple or the earnings multiple. PE ratios are used by investors to determine the relative value of a company's shares in apples to apples comparison. It can also be used to compare a company against its own historical record or to compare different markets against one another over time. PE may be estimated on a trailing, backwards-looking or forward-looking projected basis. The price to earnings ratio is one of the most widely used tools that investors use to determine a stock's relative valuation. The PE ratio helps one determine whether a stock is overvalued or undervalued. A company's PE can also be benchmarked against other stocks in the same industry or against a broader market such as the S&P 500 index. In essence, the PE ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. This is why the PE is sometimes referred to as the price multiple, because it shows how much investors are willing to pay per dollar of earnings. If a company was currently trading at a PE multiple of 20, the interpretation is that an investor is willing to pay £20 for £1 of earnings. The PE ratio of the S&P 500 index has fluctuated from a low of around 5 times in 1917 to over 120 times in 2009, right before the financial crisis. The long-term average PE for the S&P 500 is around 16 times, meaning that the stocks that make up the index collectively command a premium 16 times greater than their average weighted earnings. Most investors will say that it's better to buy shares in companies with a lower PE, because this means you are paying less for every dollar of earnings you receive. In that sense, a lower PE is like a lower price tag, making it attractive to investors looking for a bargain. For instance, if a company has a low PE because its business model is fundamentally in decline, then the apparent bargain might be an illusion. The PE ratio shouldn't be used in isolation as it doesn't tell you the full story. It should be used alongside other tools and ratios during fundamental analysis. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.